Hello, my name is Gerald, and I want to thank you so much for showing up today. In these episodes, I will always speak directly to you and never ask anything of you except to like and subscribe. Nothing in this video is financial advice. Alright, it's time to share with you my thoughts on how you should go about taking profits and averaging down. To do so, we are going to imagine that your portfolio is a pirate ship. You are the captain of your pirate ship, and the crewmates are your dollars and investments. When your crewmates are safely below deck, you are holding cash, but when they are above deck, you are holding investments. You never want all your crewmates above deck because then you have no cash on hand to buy investments. You also don't want all of your crewmates below deck because your pirate ship won't move and you won't be making any money. It's important to hold some cash because it allows you to average down. Averaging down is the concept of purchasing more of an asset that you already hold as it drops, effectively decreasing the average price at which you purchased the asset. A storm brewing is the equivalent of one of your assets dropping in price. As the storm worsens, you will begin calling your crewmates up to assist in keeping the ship on course. The more men you call to deck, the more risk you are taking on. You never want to call all your men to deck because then you are risking the lives of your entire crew. The worse the storm gets, the more crewmates you call up to help. Then the ocean begins to calm and the sun comes out, and the assets begin to increase in value. As the weather gets more and more pleasant, you begin sending crewmen below deck so they are well rested in case there is another storm. This is called taking profits. Not only does taking profits lock in your gains, but it also gives you some cash on hand to take advantage of dips or decreases in the asset's price. Okay, so let's put aside the pirate ship analogy for a bit. While it's a useful way to think about the flow of money in and out of assets as you take profits and average down, there are some details of this strategy that I would like to discuss in a straightforward manner. First of all, averaging down is not always a good idea. An example of this would be if you owned a small fracking company whose value was plummeting as the cost of oil decreased. In this scenario, there is a chance that this company could go under if oil prices don't go back up fast enough, and the company is likely not running a profit during this time. So of course, in this case, you wouldn't want to average down because there is a legitimate reason for the stock crashing, which is the increased risk of you losing your investment. The stock not only costs less, but its true value is less as well. Now let's say you own Chevron during this time. Sure, oil prices are low, they are laying off workers, and their profits are decreased, etc. But Chevron is just a Goliath. They will be able to weather the storm until prices go back up, at which point their stock price will recover to pre-downturn levels. So if you owned Chevron as it began to drop, I believe it would be a good idea to average down and purchase additional shares at many different price points as it dropped and dropped and dropped. Really, my point is that you must carefully analyze your investment, determine the likely reason for the drop, and decide based on that whether or not you should purchase additional shares. For example, if everyone is freaking out over something political or COVID related or something like that, then the price is likely dropping as a result of fear, but the actual value of the asset has not changed. Now, as far as taking profits goes, there's truly no right way to go about it. I think everybody has their own strategy, and you need to determine your own. The main strategy that I use is if an asset increases by a lot in a short amount of time without any indication that the asset is now worth a lot more, I sell like 10% or so. On some riskier assets like Bitcoin, I have set points for myself at which I sell 5 to 10% of my holdings if the target price is achieved. I plan on selling at many different levels because no one can predict when the next great Bitcoin drop will occur. It's always a good idea, really, no matter what asset it is that you're purchasing, is if you're buying it as a short to mid-term investment, set markers as it goes up where you will sell a percentage. Don't just buy it and say, yeah, I'll sell it when I make some good money, because then you're allowing yourself to play into the fear and greed aspect of investing. You never want to do that. That's what you want to control. You always want to control your fear and greed, and never buy based on greed and never sell based on fear. Well, I mean, never buy based on fear either, but that doesn't make a whole lot of sense. All right, that's going to be it for this episode. I hope you enjoyed it, and remember, don't have all your crewmen on deck and don't have them all below deck. You must find a balance. Okay, now that I started sounding like Yoda, I assume I'm rambling too much, so I'll talk to you all soon.